Stocks had a little hiccup today. The question is whether it's just a hiccup or whether it's the start of more of a pullback, more of a retest, and how that retest will look like. So I'm going to break down today's video from that perspective and take a look at the technicals to see what they're saying and what they're showing and what we can expect to see not only in the next couple of days, but over the next couple of weeks. So we're going to break that down. We're also going to break down a significant change in leadership that we've seen in the markets, in fact, this past couple of days. And also a couple of interesting moves in different markets, different other asset classes that also can kind of paint the picture of where we might go over the next month or two. So I'm going to break all that down in today's video, as well as our trade idea, taking a look at the type of pattern that we'll see from a broad market standpoint. That will be the type of pattern we can trade. So let's go ahead and get started. Today is Wednesday, April the 15th, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's go ahead and take a look at the S&P 500 with the market forecast indicator. As you can see, we still have the yellow line. We're above the moving average, which makes it yellow, but it's falling. Again, that's what makes it yellow. If it was rising, it'd be green right now because we're above it. But it's falling, we're above it, it's yellow. We got the dark green shading, which means the intermediate line's up. I've shown you before, there's plenty of instances where we've had dark green shading in the midst of a bearish run, right? The bearish run's not over until you get the dark green shading and the green line. There's plenty of examples of individual stocks that look like that, but right now the broad market doesn't look like that here. And the near-term line, you notice, has come back down, and it did not really get into that upper reversal zone and stay there like you can see it does when it's on bullish runs, where it gets up pretty high in there, and it will stay up above this in the upper half of the chart. It's been up there for a good while. We've had a good little run here. We did get up to higher highs, but the fact that we didn't really get that entrenched in the upper reversal zone up to higher levels, up kind of this 90-ish level, that's a little bit of a concern. Again, not a like, oh no, we're gonna fall off and have another low. And at least a concern that this near-term run might be over, considering we closed below yesterday's low point, gapping down and not filling in that gap yet, as you'll see here in a minute. This is a bullish pattern itself. You got a bullish trend with an oversold momentum line. That's typically more of a bullish pattern, as you can see all these examples here. It's typically more of a bullish pattern when you're in a bullish market. Dark green shading, but we're not, dark green shading and a green line, and we're not in that. So I wouldn't put a whole lot of stock into that pattern right now, simply because of, we're not nearly as bullish as we think we are. If we take a look at the Russell, that looks even more bearish, right? We're back down, almost back down below the moving average, like flirting with it turning red again, just like that. We still have light green shading. We don't have dark green shading because the intermediate line is not above 50 yet. The near-term line has come back down below 50 with an oversold momentum line. And, of course, the market sentiment is still kind of right at that 20 level. So, as much as all these big, large-cap names, especially in the NASDAQ here, have kind of kept us afloat and kind of made us look a lot more bullish than we are, the Russell 2000 paints a different picture. It's a lot more bearish. You can see we held the 38% retracement of this bearish run that we had versus the S&P, which is at a 50% retracement of this bearish run. So if we go from that high up there down to this low point, we got right about to a 50. We briefly broke up yesterday above the 50% mark, and now back down below it. So we'll see how that plays out. Again, the expectation is that we'll pull back down to a new near-term low point. The question is, where's that next near-term low point going to be in relation to this one, the last near-term low that we've had? According to the trend, you'd expect it to be higher. I think we'll probably if we do get higher, we'll probably come into this area, if not test it, or come down a little bit below it. But I think you're going to have some support at the top of this gap. And my expectation is that we'll fill in that gap. So I think you'll get some support in this area here where the next near-term low will be, when the near-term line pulls back down below 50. Now, the last one was a really bullish near-term low point. It was a higher low. We only stayed down below 50 for a couple of days, and we were right back up above it. But considering that we're getting kind of short near-term runs, not the long ones that typically start bullish run. See how long this near-term rally was. Those are your typical, that starts your typical near-term intermediate runs, the long ones. We're not really getting that right now. And now we're pulling back. And so again, I wouldn't be surprised if we turn into light pink shading here once the intermediate line rolls over relatively soon. And the question is going to be how far down we go. And I think that the moving all the way down here is off the table now, considering how much we've rallied. Not 0%, right? If we fill in this gap down here, this runaway gap, which right now would be considered a runaway gap, if we fill that in, then we're probably going down towards 2100-ish. That's the level I've been talking about before. I just don't think we'll get down to those levels. I think we'll stay at worst. I think we'll get back to this 2350 level, unless the narrative changes. Something changes in terms of how bearish we really are. But I wouldn't be surprised actually if we kind of stop in here, 2500. In that 2500 area, and stop at that point, and then try to figure out a near-term low from there. As always, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video. If you click on that, that will notify you when all these videos are posted. Hit the thumbs up icon that's down below the video too. That tells us two things. Number one, you liked our video today. And number two, you want us to do it again tomorrow. So it's our only survey we give out. We take a look to see what you think about our videos by whether you click on that or not. If you don't like our videos, then you don't have to click on anything. Also, while you're down there, comment, what did you get out of our videos today? I always love to see what you're getting out of them. Join our website at marketscholars.com. There's a link popping out in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you watch this on our website, again, you can check out some of the things here around on the blog post. We invite you to engage with us here on social media. Click this heart. It opens up this window. You can like today's Market Outlook tweet there. Click this thumbs up. It takes you to your Facebook page. You can like today's Market Outlook Facebook post. Again, if you engage with us on those platforms will push our content to you. They of all the people you follow, they push content of the accounts that you engage with the most. So we try to make it really easy for you to do that here. Check out our classes up here. You can see more of our classes with that link. Also, you can just mouse over trading rooms here at the top. And also, here's our Market Outlook live trade review. Again, monthly subscribers get access to our Market Outlook lives and all of our trading rooms. Our Q&A sessions is one of the perks that our premium subscribers get. You get one of each of us. Brandon does one, and then mine are on Saturday mornings. All right, let's get back to the charts here and take a look at the long-term view. And again, we're got a pretty decent close, but you notice we're not closing above the high point of the week. So yeah, it kind of slows us down a little bit, and that's okay as long as we get higher highs. And you notice we did get a higher high on that. But we are still, despite this week's higher high, we are still flirting with that 50-day moving average and really this upward trend line. So that's kind of why we're stalling here in this area, and wouldn't be surprised again if we didn't come back down into these spots, into this area here, that 2550 again we've talked about. 2450 even lower, kind of another support level into that spot. So that's from a long-term viewpoint, you can see kind of why we're stalling in this area. You look at the 3 green arrow chart, of course, we've got 3 green arrows, but you notice the stochastics is crossing. Look at the volume really rolling over now pretty sharply. Look, all this volume really light. It's pretty high compared to where it was before this level. So still relatively elevated levels. As you can see, my horizontal line all the way to the left. We were never, only the really bearish days and one bullish day did we have volume that even that came close to these levels. Where even though this is a lot lower than where we're at right now. But you can see the MACD histogram starting to roll over, which means we're just losing momentum. Doesn't mean we have to go down, but it means we're losing momentum. You can see the stochastics also. The key for the stochastics will be to watch to see if and when we cross back over below this moving average here. Its moving average, because that's when you'll start to see some weakness here. It's a little different now. Up here you get we're crossing over, but we were on bullish trends, right? You can stay up here for a long time. But this is a little different because we're on a bearish trend here. and you can see the MACD rolling over as well, with the moving average just barely flirting with crossing above zero there, with the 8-day and the 17 days. We want to keep an eye on that and see where we're closing relative to the those moving averages. You can see where on the Russell, those two lines are right there on top of each, or all three lines are right there on top of each other. So keep that in mind too, as they kind of converge, to see if we don't diverge again back to the downside. All right, so now let's take a look at the intraday chart. So of course you can see now, we filled in the rest of that gap from yesterday morning. We filled in most of it overnight, but you can see the rest of it. You can kind of see why gaps are so important. Most of our trading range today from this 284, almost 285 level down to this low point, you can see a lot of it occurred overnight. That's why gaps are so significant, because there's hardly any volume. I mean, this is pretty low volume on an individual day, but the volume overnight is extremely light compared to that. So that's why gaps are really easy to get filled. And I think that's a common gap too, and we'll probably fill that gap in as well. So we want to keep an eye and see how we do that. But I still think too that we filled in this gap here, most of it. But this is a common gap, which means we can come all the way down. I've told you before that 2,500 level, 2,550, a little bit above it, but 2,500, filling in that gap. There's going to be some significant support now in that area. So I think that's going to be kind of that's the higher probability area of where we're going to fall down to. Again, another area of support at the top of this gap here, where this volume node is, kind of the bottom of this volume node. If we break down below that, there's not a lot of volume holding us up, as you can see. If I go out even further on this, you can see here's the gap in volume that could be very, very easy for us to fill in. So that's why it's like I don't buy a whole lot into this move. There's not very much volume in between here. Lots of gaps, overnight gaps to the upside. Lots of overnight gaps to the upside. So because of that, a big vacuum of volume to close in. You can see there's a gap over here in this area as well. Big vacuum of volume to fill in there. But again, there's where your support is. So pretty significant level of support. But again, break below this 240, break into this gap. Not very much volume down there anymore. So pretty significant there in terms of where our support is. And of course, from a long-term viewpoint, if we were to break below this gap, so this is where the gap is. If you were to break below this gap here, so it'd be like right. Are we not showing it? Oh, sorry, this is on a weekly chart. It's on a, here, let's change this to a daily chart. That's why I'm not seeing it. So same volume profile, just on the daily chart now, but there's the gap. So you see if we fill in that gap, not much volume until we get back down to this 210. That's where your real significant layer support will be, and that's, we break through that, then it's clear sailing to the downside, and that would obviously be, that's going to cause a lot of consternation if we happen to fill in that area. If you take a look at the Ichimoku cloud for the SPY, you see how we're still below the cloud, but you also see that for us to stay below the cloud, we have to, there's the kind of trend line that we follow. So that's just something to keep in mind, because that will act as a resistance for us as we get closer to it. So just kind of keep an eye on that kind of trend too. We might come down towards this 250 area within the next couple of weeks through this April expiration and beyond. The trend, as I told you in previous, the trend here is not very strong. It's still weakly bullish, so it hasn't really gotten going to the upside to where even on the moderate strength level we can say, hey, we got a pretty decent trend going. That's as bearish as we were. That bullish rally has gotten us to a weak bullish trend strength. That's how significant. That's a pretty strong rally we've had, but this indicator kind of puts into context really how strong it is. And of course, the DMI also puts into context how strong it is, because if you look at the negative index, it's barely flirting with falling below 20. That's how bearish we were. And the positive was so low. This rally, all this rally did was just barely get us above 25. I mean, that's a bullish pattern. That's why it's green. But you notice it's just barely above those levels. It's not like we're really starting to move away from it. We start to move away from here, it's a different story. But it seems like it's moved enough to, again, kind of get people thinking, hey, things aren't so bad after all. And then, again, we've talked about that testing the lows bandwagon. You get more people off of it, then you start to actually do it. Let's take a look at the volatility index here. First of all, we talked about we don't really get a low point until we're at least testing this 3% mark. So we're not there yet. But volume and trading ranges are finally starting to drop a little bit here. And that's a good sign. At least if we do come down, we're not going to come down explosively like we've done before, like this run was. But take a look at the volatility index as well. One reason why we weren't so bullish here either is as volatility has been dropping, it hasn't been dropping on a relative basis. It's still very high. It's still at a very elevated level, even though it's a lot lower than it was. Even over here, when we first hit the 105% mark, that was at 50, and now we're down to 40, and we've been below 40. Yet we're still at the same levels compared to the back month volatility. So it tells us, again, we're not as bullish as we think we are. We're just not nearly as bearish as we were. And the extent of this bullish bounce is simply a function of 35% drop in 4 weeks. You're going to get a big bounce coming out of it. That's just the reality of the situation. All right, so before we take a look at what's driving this market, a quick summary of our technical outlook then is we've had a good little run, not as bullish as we think. We're starting to get some signs of rolling over, of coming down. We've seen those today, and the signs kind of show that the expectation that we'll probably continue to go down. We probably won't go down all the way to the low point. We won't go down nearly as fast. There are some support levels now on the way back down, some pretty obvious I pointed out. And so that's my expectation. I think, we're going to take off, take a breather here. Change the leadership. The leadership on this rally has been utilities and real estate and energy and beaten up areas, or beaten up the most. So as we kind of roll back over and take some profits out of that, then we change up the leadership, as you'll see here in a second, and then get going again and be more likely to be forming the low point instead of just a low point. So what do you think? Do you agree with that assessment? Do you disagree? There's a link popping out right there on the top right corner of your screen. Click on that link. It opens up a poll. You can hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing? Don't just give me your opinion, because everybody's got one of those, especially in the anonymous internet, right? But share what you're seeing as to show us why you're either more bullish or more bearish, whether it's a chart or an indicator or an economic indicator, whatever it is. Share that with our community down below. All right, now let's talk about what's driving this price action. And you can see one of the biggest movers to the downside today in the last couple of days, really since the beginning of this week. If I were to go to the beginning of the week here, so this last 3 days, has been a pretty sharp drop in crude oil. Now, crude oil had a lot of gains to recover, so but that's a pretty decent low move to the downside. And you can see safety has been the trade of the week so far. Gold and bonds holding up. The dollar's relatively flat. Stocks are flat. Move to the downside, move to the upside. So we're kind of getting a little bit of a doji pattern. International stocks down, especially developed market stocks. I saw something that was pretty interesting. There's some chatters today about commodity prices. And there's a chart I shared that probably wasn't the best chart to share to reflect that. Just how bearish commodity prices are. Commodities relative to stocks are really, really low. There's not a very good chart to show you like just stock price return without the dividends. So it makes it an unfair comparison to show it against crude oil. That also is not a total return either. That's just the price of that particular commodity. But I did want to show you this chart. So this kind of gives us an idea of just where we are in comparison with crude oil to stocks. And I'm going to go back to I'm going to go back to the let's see here. We're going to go back to January 26th of 2018. That's the peak in the market where I think we turn into a bear market from there. And then we'll hit OK. And then what I want to do is I want to show this as a percentage. And then I want to take off the left scale over here so we can see them both as a percentage. So you can see, initially stocks rallied, went up to higher highs. Crude oil, like stocks were up just a little bit, a couple percentage points from that January high. Crude oil was not. So crude oil is a lagging indicator. It was about 14% off of that January peak. So that, so it made its run late, and that's to be expected. That's what it typically does. Had some pretty volatile ups and downs. But then you can see it went from a 14% gain up above that January high point to way far down below, right? So let's see here if I can fit. Might need to change this to fit the studies. There we go. So it went way far down below. So we went down to about 33% below that low point of that January 26th peak. So very significant drop in that Christmas Eve low. And then of course both bounced, not surprising again. But you can see equities basically came back to that October high point, and that's where they peaked. But crude oil didn't. Crude oil did not even get close to its October high point, and was barely flirting with its January high. And we were above the January high in stocks. And then you can see as we went to kind of sideways action here throughout the summer, we were down pretty sharply. So in stocks, we were down just a little bit from this peak to that low point. But in crude oil, we were down quite a bit. We were only down, we were flat. We had gotten back to flat from that January peak that initially started. By the time that October low point came, we were 20% down below that. So again, a reflection of just how bearish we were, even though equities, S&P specifically, and FANG stocks specifically, were helping keep stocks up afloat here. And then we really took off. So we took off here to a peak in equities that was way up above all these high points from the summer. It was well up above that October peak from back over here, as you can see, and then well above the January peak, of course. So about 13% above that January peak. Crude oil was not anywhere close to any of those. So a little bit above these highs, but still below that one. And obviously still way below the October high point, and just a few percentage points below. And then crude oil tanked while stocks rallied up. And there's your peak there. By the time we hit the all-time highs in stocks before we dropped, crude oil was down still about 20% from that January 2018 peak, and stocks were up 20% from the January 2018 peak. And then we rectified that situation very, very quickly. And as we dropped, so did crude oil, down 66, 70% practically from that January 2018 peak. This is the futures contract. A little bit of a bounce, not surprising. Same thing, we bounced in stocks too. But here, since this peak on April the 6th, essentially, April the 6th, April the 3rd, crude oil has been dropping ever since then, while stocks have been rallying. So again, another little bit of a divergence. Crude oil's flirting with this low point. Stocks nowhere near that low point of where it eventually bottomed out. Actually, crude oil went down a little bit lower than this low point to a lower low, and now it's flirting with that lower low. Stocks haven't. So it's, again, just to show from a long-term viewpoint just how oversold crude oil as a proxy for commodities as a whole, how oversold it is relative to stocks. Very, very, very big discrepancy there. It just reflects, where kind of we're at in the economic picture and what to expect, right? It's kind of, again, it's hard for stocks to get going with crude oil breaking below its floor like it did essentially. It went well below those December low points. Stocks didn't really. I mean, you can see stocks came to those December lows and then briefly went one day below it, popped right back up above it. So that's where the 38% Fibonacci line is, or that long-term bullish run off of the March 09 low points. We basically hit the 38% level of that move. Crude oil went well below those lows, right? So it fell through the floor compared to those December low point that we had, and in fact, kind of doubled the losses from the January peak. So again, it's going to be hard without crude oil also making a run up as a function of economic demand and economic growth expectations. Don't be surprised if we don't have some volatility through these ups and downs with what we're seeing here, and we're seeing some risk aversion, a little bit of risk aversion so far here this week. Let's take a look at the dollar. That's another chart that really kind of stood out to me today. Here, not the market. I want the market forecast. Sorry, this chart. Let's take a look at the dollar index. The dollar index has been bouncing back up. So we got this really bullish pattern of light pink shading and yellow line in the last and that was on Monday. In the last 2 days, actually, excuse me, that was yesterday. Today it bounced, and then so far tonight it's bouncing. So it's a really bullish pattern here. And again, usually when the dollar is bullish, equities are a struggle to kind of get some traction. I don't think the dollar is going to be on a long-term bullish trend, but I think there's some potential weakness here in the dollar, and that's translating to what we're seeing in equities, some risk aversion in equities. Same thing with this pretty big drop in yields. How much of these lows are we going to come down to? Again, you look at a comparison chart. Sorry, here, let's remove all these and then pull up the comparison chart of yields with the S&P 500 to see a little bit of a discrepancy, right? So you can't, it's kind of hard to line it up too much, but you can see how equities hit a higher high when yields had already come down, similar to crude, right? Remember, crude peaked right over here. This is where crude peaked. So yields kind of came down with crude, even though stocks continue to rally. Just like crude oil, yields kind of peaked early. So crude oil peaked right here on this dip on the purple line. Yields dipped on this one. So yields had stopped. Equities went much lower and kind of caught down to where yields had stopped, bounced to. Then you can see there's the bounce in yields, and an equivalent bounce in equities came a little bit later. But now we're rolling back over on yields and rolling back to the downside. And from what we've seen, that kind of has been leading the equity movement. That's a pretty significant drop too. That's not like kind of an intraday range there. It's a pretty significant drop on yields that has the opportunity to be bearish as a reflection of bearish risk. I mean, we're back to dark pink shading just like that. Bearish near-term high point because you barely got above 50 and came right back down after one day. Obviously did not close to getting above 80 on this one. And like I said, closing below all those highs, filling in gaps. Pretty bearish drop on yields. So where can yields trade into? You can see we can trade in that range. The monthly range, the monthly candle for yields. Just like in equities, it's very easy to trade within that long lower shadow. So I've said that before, that where can we trade? Well, when you have equity, when you have long lower shadows here, you trade within that range. Well, this is where we're at right now relative to that range. We're not in that range right now. So to get back down to 2,500 gets you back towards the top end of that range. Yields are already down into and more flirting with that area. So it kind of shows us what we can expect to see with equities here in the next week or two, especially with this expiration. I think this April expiration has been suckering in a lot of people and holding equities up. Once that expiration date's out of there, then you'll probably see some opportunities for some movement and not just be overbought or oversold. In this case, oversold technical movement. Where we're so oversold that you just bounce, right? Now you'll get a clear direction one way or the other, either V bottoming to the upside or getting us some more choppiness because we've lost the extreme oversold condition that produced the bullishness that we've just experienced. Now we're not so extremely oversold anymore, so now what's going to make us more bullish going forward and keep us up here? We don't quite have that anymore. We need to have, and what we'll probably end up getting is more and more news, as well as bullishness in the dollar and bearishness in yields and crude oil, that will kind of keep stocks down. Now, not explosively down, but just keep them choppy and keep them in the lower end of this range for the next little bit. All right, now let's look at the sector comparison here. So let me bring that up. And take a look at, and here's another little bit of a pretty decent sign here. Again, that we won't be so explosively bearish in the downside moves. But you can see the leadership has changed. So these areas here led the way up on the bounce. Now they're rolling over. I mean, those for the week we're flat on the market, but not those areas, right? Utilities down 4% on the week. Real estate's down 5%. What's kept us from being down, as well as industrials, materials, energy, if they're down too, not surprising. But what's kept us from being more bearish than we are this week so far is the fact that these mega cap tech, Netflix, Nvidia, all those large cap tech names have all been really bullish, and that's good. On one hand, that's really good. That's the leadership we need to see. Unfortunately, we need to see that leadership from an oversold condition, and they're not oversold. Amazon, Netflix, they're hitting all-time highs. And we saw this in February where everything else was really bearish, but the markets kept going up because these areas led the way up. So it's a little bit of a concern that's like, okay, now that we've been bullish, now that we've got our oversold technical bounce, to avoid us going down, we're trying to get into these big names, and they didn't hold up very well in March as that divergence finally played itself out. And so the question is, how is this divergence going to play itself out? Well, we've seen in the past, if we come down to new lows, then we would expect these to lead us to the downside again, and this to hold us up. And if that's the case, and we get some more oversold conditions there, that would be perfect for the market to set the low point and then move up from there. All right, so for our trade idea of the day, this idea of things rolling over is kind of the theme. So if I were to take a look and to kind of show you what that rollover pattern would look like, let's take a look at Archer Daniels Midland. You can see it's still got the yellow line and green shading, dark green shading even. But you can also see how bearish this little drop has been. I mean, we dropped below all these lows. So, 1, 2, 3, 4, last 5 days lows, we closed below. The near-term line dropped back down. Never did get up above 80. So again, not reflecting, we haven't had any bearish near-term highs, even though these have been, higher highs. We still are not getting real significantly bullish high points here on the near-term line, and we're dropping back down. If you take a look, at the 3 green arrows for Archer Daniels Midland, you can see that the histogram is coming down. We're back below the 8-day, flirting with getting back below the 17-day moving average. Stochastics falling below its moving average and rolling over both the MACD and the stochastics coming down. Like the S&P 500, this stock is also at its 50-day moving average. Really small. I mean, that's the kind of body you start to expect to see on the S&P. You've had really good bullish candles here, closing above the last couple of weeks' highs, very bullish, but then a really small body. And I'm going to venture to guess next week we'll get a really small Hakunashi body right at the 50-day moving average. You take a look at its Ichimoku cloud. Here we go. You can see there is no bullish trend anymore. The noise balance indicator is back down to the noise area. We're back below the green line, rolling down below the Ichimoku cloud. Take a look at its DMI pattern. Yeah, you can see we're, again, we kind of were flirting with it above 25 and below 20, and that didn't last very long. So this type of pattern we're seeing here is a type of pattern I expect to see on the S&P, just happening a couple days earlier right now on ADM. So it kind of gives us an opportunity for a bearish trade. One more thing too. Let's take a look at the Bollinger Band. Sorry. And you can see the stock is trading right at resistance, right at the bottom of the value area, right at the big volume node, right at some resistance here, flirting with the moving out, getting into the lower half of the bandwidth, and there's a lot of room to trade in the lower half of that bandwidth without necessarily getting significantly bearish, right? We can come down into this area. So it gives us the opportunity to do a bearish trade. So let's take a look at this bearish trade here. And you can see that we have, we're buying, I'm buying a put, a May 34 put. There is earnings coming up before May expiration. We sold, to cover some of that cost, we sold this 31 put. That means anything below 31, I cap my gains. I don't necessarily think it's going to go too far back down below 31 because, again, there's going to be some support in this area. There's support at 32. So if we get to 31, that'd be great. So you can kind of see, there's some gap. There's a gap here that we need to fill. That's easy to fill. And then you're going to have some support here. And you break through that support on an intraday basis, it's going to be really easy to get down there. And if it doesn't, then we have a small loss, right, for a pretty decent reward opportunity if it does work out. And you can see the maximum gain. As long as that maximum gain stays within a 1 standard deviation move, then we have plenty of time to let it work out. So that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link to go to our Market Outlook forums at marketscholars.com. One of the things you get with your when you subscribe for free is access to that forum. And let's keep this conversation going. Open up any new thread about any questions or comments you have about our video. Comment anybody else's. And let's keep this, like I said, this discussion going. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content in between the videos. Join our Market Outlook Facebook group that we've created. Have a great rest of your Monday or Wednesday evening, everybody, and we'll see you all tomorrow.